So I'm going to ask a couple questions before we open it up to everybody. First is I'm just curious to hear what your thoughts are to the Berkshire meeting today. Just any takeaways, general thoughts. Personally, I liked this meeting a little bit more than last year. I thought Munger came out swinging a little bit, you know, some good energy and stuff. But I'm curious to hear your guys' thoughts on or takeaways on the meeting today.
Yeah, I thought this was a lot more interesting than last year. The questions were better, the answers were more thorough. Particularly the afternoon session, I thought was even more interesting. Got into more personal type of questions.
Yeah, I liked it. He almost told a story about Ben Rosner, which I was interested in because I've always been curious how it did so well and then immediately fell apart. All they said is, you know, we could never find him a replacement, immediately fell apart. But yeah, I thought that was interesting, and the idea that they might have stayed in banking instead of going to insurance if the law hadn't changed. So there were some old stories that were pretty interesting.
Yeah, I agree. They just seemed much more sharp this year, honestly, than compared to the last few years. And I remember last year actually being a little worried. And it is, you know, it's amazing, obviously, given their age, how sharp they continue to be. And some of the old stories were very interesting, things that I hadn't heard before either.
Yeah, no, it was a great meeting, like you're saying, compared to the previous years. I think the questions were, maybe the questions were vetted better, and there were more new and different ones than what the traditional ones that you hear year after year.
So one thing that gets passed along or around a lot about Buffett is that, you know, if he was managing smaller sums of money, he would be able to put up like 50% return, just outstanding performance. Well, today he kind of reiterated and talked about that again. He said, you know, if I was managing smaller sums, I would be able to do a lot of different things, and I'd focus in, you know, more overlooked pockets of the market. So I know Keith and Steve, you guys were talking a little bit about some ideas, but just overall for you guys, is there any new investing themes or ideas or anything that you think is currently interesting that you guys would like to share?
That'll make us 50% a year.
That would be great. So, yeah.
I'm not sure if it'll make it 50% a year, but I think the one thing that we just talked about previously, and I like to hear some of the other panelists' thoughts on this, is just the increase in interest rates and the shift in cash flows from equity to debt. And what I've noticed, at least from a top level perspective, is some of these debt-related investments are becoming competitive with equity in terms of the rates of return you can get on them. So and that hasn't happened in a long time. I mean, it was probably what, before even 2000, before you could say, okay, I can get a decent return on debt investments versus equity investments, and just the potential changes for that. I think that's an interesting sort of theme that's happened over the past year, and it looks like if the short interest rates stay high, it's something that can continue on for a few more years.
Yeah, we don't invest in larger stocks, but I think movie theaters, airlines, a lot of things that were hurt a lot by COVID look interesting in terms of them not performing well still on price versus that. And those are some of the only industries I see that I think look really cheap. There might be some cheap banks, but there's a lot of bad things that could happen in the future there.
For me, it's the consistent theme of finding opportunities outside the U.S., particularly Poland is very attractive. In fact, if you push me hard, I would say Poland is going to be the South Korea of Central Europe. You've got a belligerent communist force on the border, and you've got the Western world pumping all the resources through Poland. That was the case back in South Korea, and this is an even more better educated crowd with a better sovereign balance sheet. And there are some terrific opportunities in Poland.
So I'm going to ask one more question, and then we could open it up to the crowd. But so Buffett today, he was talking about just like the fun of investing, and he referred to golf. If you were golfing and you were going to hit a hole in one every single time, it would probably take like the fun out of it, and how even in times where things didn't work out, it was just still a ton of fun. And I love how spontaneous investing can be. So I'm just curious, just sort of fun. What is the most random way that you've ever found a stock idea?
Oh, that's a good question.
I mean, I get texts from Tom. Thomas Brazil, for those of you who know him, is a very interesting guy. He's had a lot of asymmetric ideas through the years, and he and I he lives in Italy right now, and I'll get random texts at 2 a.m. from him, just with a thread, like nothing else, and I'll wake up and I'll see this this thread, and then give him a call and we'll talk. So that actually happens pretty frequently. So I don't know how random it is, but it is, I think, a little odd. I don't know if you come up as a traditional analyst, I'm not sure you're getting texts at 2 a.m. from your friend from across the world about some little microcap that's going through something.
I mean, I think the ones that I find most interesting is, and maybe it's not more random, it's businesses who basically there's only one public company that does this stuff. And basically all their competitors are private. And you're just like, okay, you only have this opportunity. And especially if the guys have bigger, more scale and more resources than the private companies, I think that's sort of not necessarily random, but I think those are sort of interesting situations that basically, because what we typically do with industries, if you just look at companies and company lists, you're looking at companies that mainly have other competitors within the market. But if you can find these smaller ones where basically they're the only public company, they provide some interesting opportunities, I think, to look at.
Okay, so we're going to open it up to questions from the crowd. So there's a mic over there. You guys could line up, or probably the best way to go about doing it. Go for it.
Hey, Christian Zay from Boston. I was actually curious to follow up on Will's question on the maintenance versus like searching for new ideas. And I think maybe particularly to contrast between sort of the smaller fund management structure versus like a more conventional structure of, lower level analysts frenetically updating models and, sending out notes. And I'm kind of curious how maybe your process with like following earnings, this sort of thing might contrast with that.
I mean, I guess I didn't, for the maintenance thing, for me, a lot of it is doing a comparison, because it's, in my perception of this is, I've got a set of companies in the portfolio that I think are going to get good risk-adjusted returns. So it's almost like trying to say, okay, anything new that comes in has to basically have a higher expected return or lower risk than what's in there already. And so for me, it's constantly sort of that process. So the maintenance is more of an ongoing type of thing, and for anything new to get in the portfolio, it's got to be higher. It's got to have a higher expected return or better risk reward than what's already in there. I guess it's sort of like the way at least I look at it. It'd be interesting to hear how other people sort of do that maintenance versus like idea type of.
We do very
process.
very little on maintenance. We don't own a lot of stocks, so we mostly look at them quarterly. And it's just a question of whether it's outside the bounds of what we were expecting. Like, we invested in a bank, and the asset growth one quarter came in way higher than I would have expected. So then you dig into it, and But most quarters for most stocks we own, it's pretty boring. You could have predicted within a few points what would happen.
Yeah, for me, about 80+% of the time I spend on the existing portfolio, not necessarily looking aggressively for new ideas. And so it's not just an earnings season where my maintenance work would be intense. It's an ongoing exercise of trying to learn a lot more about the company. In practice, TIGAs, other conversations with management team, competitors. So it's an ongoing exercise. It's not just a matter of updating some Excel spreadsheets for coming out with a number. It's more to sort of holistically better understand the business over time.
Will Vaughn from New Jersey. I have a question for Keith. So I've looked at Ashtead, and I think the equipment rental business is very interesting. That industry is very interesting. The question I have for you is, why Ashtead and not United Rentals, the American equivalent that's maybe a little bit higher market share? Like, what do you think about comparing those two businesses?
Well, it's a very interesting question, because I think the two companies have two different approaches to rentals. Both companies were really hurt in the 08-09 decline, and they've taken two different approaches. United Rentals have said, okay, we're going to just, how we're going to prevent this from happening again is do national contracts. and you read through their investor presentation, it's all about these big contracts they have. And the upside of that is they have scale, so they should get an advantage, but the downside, it's much more commodity-based. Ashtead, on the other hand, has said, okay, we're going to compete in there, but their focus is more on the small to mid-sized businesses, where they can take advantage of the clustering economics. And if you look at both companies, Ashtead is smaller than United Rentals, but Ashtead has better returns on invested capital and those types of things. And you see the same situation like in the car business. Look, compare AutoNation to Asbury, and these guys can be smaller because they're using this clustering strategy, which in my mind is what wins local businesses. So if you have a local economies of scale business, the local economics is sort of what wins the game. And so that's what I see as the difference. I mean, Ashtead always trades at a premium typically to URI, but in my opinion, I think these factors will make up for the difference. I think both of them are going to do well because I think the business, from a long-term perspective, is a really interesting space, and the multiples that they're trading at now don't reflect either the historic or the forward-looking sort of growth potentials of both businesses. So,
thank you.
Yep.
Hi, Casey from Charlotte. Can you tell me how you weigh front-loading enough capital on the first initial purchase or two versus being more cautious and spreading purchases out at the risk of losing on upside?
I mean, I can't. Once we start buying, we're going to buy. And like Buffett said one time about, like, you know, we don't trim. That's also true with us. So it's a question of just like getting the best price overall that we think we can. So it has to do with liquidity and availability that we think's out there in the market, and to be how aggressive we are with it.
Yeah, so I really don't want to buy into something unless I'm committed enough to make it a 10% position. So if it's something with a catalyst in the near term and there's enough liquidity, I might do it fairly quickly. Otherwise, you know, I guess something that has been kind of longer term holdings, I might buy in at 5% or so and then kind of look for a dip. And you know, if I guess you're not seeing that, I might nibble a little bit along the way. But I think it really depends on the situation. And you know, when you're committed to something, you know, to Jeff's point, sometimes you just buy into it and go with it. You know.
I mean, it's a really good question. This is what I'm worst at in terms of being able to size, because I have a tendency to, but I'm trying to change my process to improve on it. I think it really, as Steve says, depends upon the business and the business model you're looking at. If you have a business that's that potentially can have a lot of volatility, it's probably better to start out smaller and sort of see what happens. But if you're dealing with a company who's sort of a compounder over time, like an example, Ashtead's a perfect example. So I bought Ashtead in 2018 or 19. I mean, it went through COVID, and I'm glad I bought it and didn't sell it during that time, because the business, if you can find these businesses that are growing, they'll grow through this volatility. And if you can get confident in the growth, I think that's where you can really have this kind of approach where you buy it up front and you know that the business is growing. The underlying growth really at least helps me to feel comfortable that I don't have to sort of do this incremental kind of approach, which if you really try and, there's so many other things to be concerned about. If you're trying to time these things, that makes it even more challenging over time. I don't know. At least that's the way I've looked at it.
Hi, Trevor from Toronto. Just the name of a stock that you've always admired, how it's run and the business, the industry, but you could never make the valuation work.
For me, it's Constellation Software.
I would probably say either Constellation or even a company like Copart, which is a great business. For me, I guess the downside for me is I came from a deep value perspective, and that can be up and down, but Constellation, I think, clearly is the.
I think this is where following Buffett has probably screwed me out of a lot of money, because, you know, you look at, I mean, these are great businesses, right? But, you know, it's like, well, I can't pay whatever 20 times EBITDA or something like that. And if I should have, you know, in a number of those cases, because, you know, great companies surprise to the upside. And that's also why you want to be careful trimming them along the way too, because they may seem expensive now, but looking back on it 3 years from now, it actually wasn't.
And I think a part of it has to do with Morgan Housel had a really good article that talks about make sure you're playing your game. Your game isn't going to be the same game. Like my game isn't going to be the same game as Steve's or Shree's. You just need to basically buy what you think is consistent with the game that you're playing. And two guys can play two different games and come up with two different conclusions in terms of what securities they're going to buy and sell. It could be the same one. It's just, you just need to be confident in the game and make sure that you're playing it the best you can, I think, is a way to look at it.
Yeah, for me, a couple of Australian names. PWR Holdings, which does radiators for supercars, and Pro Medicus is a medtech company, competes on a global scale. Phenomenal businesses, both of them, but beyond nosebleed valuation. So I keep an eye on them. Hopefully I get a COVID kind of an impact. And
you never know.
I mean, I don't know the valuation's too high, but the only reason I have never bought Howden Joinery in the UK is valuation, and it's a mistake.
Thanks very much.
Hi, my name is Herman. I'm a software engineer in practice. I have a question for Keith because you talk about fixed securities, which is something I looked at recently as well. As we all know, at a high level, this is towards the end of the interest rate hike cycle. So most of the damage has already done. The returns becomes very attractive at this point. But on the other hand, the credit risk is also elevated because, usually companies that issue debt, they have to roll over their debt. And at this point, they have to roll over their low interest rate debt to high level debt. And some poster child is like office properties, some commercial real estate, right? Even Charlie Munger doesn't like those properties, right? Just wonder what your thought about this.
Well, I think this is where good underwriting really comes to the fore here, because in essence, you know, the duration risk or the duration stress is played out right now. But what's going to be playing out going forward is the actual underwriting. And so that's why I think if you focus on the people that have good underwriting process and do good underwriting going forward, you'd mention like the office, compare like office to multifamily, right? Part of the issue with office is some of these buildings aren't going to have any cash flow, so you have to restructure. Multifamily still going to have an amount of cash flow, and so maybe they can make it through it. But I think at this point in the cycle, one thing to really look at is look at the banks and also the, let's say, BDCs or other credit providers that have a really good underwriting record, because what's really happened is these short-term interest rates have created a very nice spreads and very nice rates of return on the debt, but you just got to make sure that you're not going to default on the debt, right? I mean, because you get all this floating rate debt, you can get these really nice interest rates, but it doesn't make any difference if they default on it. It's still not going to be an issue. But that's what I'd sort of encourage, and that's what I try to look at in some of these BDCs, the ones that are the best, that have the best underwriting, and the same thing for the banks. I mean, an interesting situation now is there's a company called Hingham who has great underwriting, sort of historical profitability, but their NIMs are getting squeezed because of this duration thing. And I think it's an interesting opportunity now for that type of thing if you can, because the downside on something like that is if interest rates, for whatever reason, continue to go up, their NIMs are going to get smaller and smaller and smaller, and and how much of it. The interesting thing about Hingham though is that it's not necessarily obvious is that their loans are turning over at 16% per quarter. So this is a temporary thing for those kind of guys. But those are the types of things I think if you dive into it, you need to really dive into it and sort of see those types of factors that can say, okay, that for me, that gives me a lot of confidence, because that means that these things are all going to reset within the next 12 to 18 months, and the NIMs should expand back out. But if you have a situation where the NIMs are getting smaller and smaller and smaller, I mean, that's sort of, in essence, what happened to like First Republic and these other banks that have gone bankrupt. The deposits didn't go away, but the NIMs got so small, the banks become, even if it's alive, it's going to be a zombie bank because the NIMs are just not going to create any profit. But I don't know. It's a good. Interesting question. I mean, I know Geoff does a lot of stuff with banks. What are your thoughts on these types?
No, I have nothing to add.
Maybe like Steve, do you look at this? Do you look at any like special situation opportunity from this kind of situation?
Related to what? Sorry.
From this like high interest rate environment, these fixed securities.
Yeah, I haven't seen. I mean, I don't have anything that I've come across lately, but you know, it's a theme. I agree to keep an eye on. I generally kind of stayed away from even getting too much into these different banks that might have any sort of contagion effect. I suppose even like Schwab and others like that. But you know, you're looking for mispricing, so it's an area to look at.
Thank you very much.
Hey, Shree. I have a question. What's the draw to Sweden compared to maybe neighboring countries like Norway, which on average has cheaper companies? And what's the draw to Swedish roll-ups compared to, roll-ups in other countries like Canada?
Sure. So my investment criteria, as I listed earlier, I'm trying to find a positive answer for 4 questions. A business that I can understand, high-quality business. High quality, I define it quantitatively as something that can generate high return on incremental capital and has great reinvestment opportunities. And then, run by honest, competent management teams and available at a reasonable valuation. And within that, the underlying theme is these are self-funding mechanisms. I'm not investing in BDCs or REITs or other types of mechanisms that rely on some outside capital. And, a few years ago, stumbled on Swedish names through my screening process and through my conversations with other managers. Norway is another interesting market, but it's dominated by shipping and oil or energy-related companies, fisheries, areas that either don't appeal to me or I don't have expertise in. So, as I mentioned, if you do get a chance, go through this book, Global Compounders, 1,000% returners, and surprisingly for a small economy like Sweden, it dominates that category.
Thank you.
And as Charlie Munger said, go fish where the fish are.
Hello. I want to ask a question about talking to management, which I think something pretty much most of you touched upon. So more specifically about a change in management. Do you see it more as a red flag or a potential opportunity? In such a case, would you rather talk to a new management or old management? Which one would you say is more important?
I mean, I probably see it as a risk usually because I was interested in the company's past record probably, right? But if it's an underperforming company, then it could be different, and you might know reasons for that. So look, if you're looking at nets or banks below a certain price to book or insurers below that or whatever, so things that aren't utilizing things right, it could be very positive. But if you're looking at it and saying this was a great company, then any change in management is a risk in handing that off. You can see that with Berkshire, right? They haven't had so many second-generation managers that have been as successful as the first because they bought great companies.
Yeah, for me, as I mentioned, I'm looking for honest, competent management teams with skin in the game. Typically, most of my portfolio companies are owner-operators or family sitting on the board. In one case, it's the 6th generation family member still running it, but if it is a significant management change with an agent instead of an owner-operator or a family-controlled situation, it will be a red flag for me.
Yeah, I mean, because you got to look at it from management's basically going to be doing the capital allocation of the business, and so I think it's especially important where you can take a look at a business, how much do these guys have to reinvest in the business and what portion of that is? So the management, they're in essence going to sort of direct it the right way or the wrong way. I mean, historically looking at management, and as Geoff had said, a lot of the key thing you can look at is, okay, if they were good management, is the transition going to be good? Do the guys have different motivations and stuff like that? And that can be somewhat reflected in, let's say, some of the compensation strategies. You may not know those up front, but at least that gives you a hint. I mean, one thing I like to look at in businesses is where the CEO and a lot of the main guys get about the same salary, and the difference is actually in stock-based compensation. In the U.S., you rarely see that. I mean, there's some Canadian companies that do it. I've seen it. Some companies like in Europe that may do it, but you rarely see it. And in my mind, it's really those changes that really, and that's where I think the opportunity is, because by the time stuff's reflected in the numbers, you're going to have some repricing. But if you can sort of see that up front based upon how management may be changing, I think that's where there's some opportunities.
Thank you.
Hi. First of all, thank you all for the time today. But this question is directed towards Geoff in particular. Several years ago, you had given a write-up on Japanese net-nets, and a key focus of that write-up was on the difference in the retained earnings yield between the U.S. and Japan, and a lot of that was driven by inflation differentials. I'm curious because back when you wrote this up, Japanese inflation was basically zero, non-existent. And I'm curious if, because now Japanese inflation is running in the 3 to 4% range, if this changes structurally or temporarily your view of the retained earnings yield, the differences between the U.S. and Japan, and if you think elevated inflation in Japan changes the business quality or the earnings quality of the net-nets.
Yeah, I mean, I think potentially some inflation in Japan could be good for a lot of businesses that have been pretty boring ones that have been overlooked there. I think a big reason is that difference between them has obscured the fact that some of the companies that grow at a low percentage in the U.S. are actually growing in real terms pretty similar to these Japanese companies. Where it might hurt, though, is there's some very safe Japanese stocks that have good dividend yields. I mean, Berkshire is basically doing a spread business there now, and that could be impacted a lot because so far it doesn't look like real yields are going to look that good.
Great, thank you.
Hi, Jason Ramage in Cincinnati. So we talked about talking to management teams. I'm curious if you also find it helpful to evaluate like frontline staff and hourly staff when you're looking at a business and their moat, and since they have no incentive to impress you, if you have any good stories, either that confirming your thesis or contradicting it.
Yeah, I find that to be very helpful, very interesting. In fact, that's one place where a service like In Practice can be phenomenally helpful. They don't necessarily access CEOs or CFOs. It's 1 or 2 levels below that C-suite level. Somebody who is, for example, in the case of Copart, somebody who has run a particular salvage yard in a particular location can give a lot of detail about the operations, the returns, and in fact, their interaction with the senior management team. So those types of sources are very helpful, and I, in fact, look for, 1 or 2 level below the C-suite interactions.
Well, you can also look at like some of these job sites. I mean, you got to take this with a grain of salt, but it does provide you, people put comments on companies. You have to, I think you really need to calibrate the responses, because a lot of times people will have somewhat of a negative response, but if you can calibrate the responses correctly, I think you can get some good information from there also.
This reminds me of a story back when JCPenney went through the management change, and I had a friend who hired TaskRabbit to go to like every JCPenney location in the country and take pictures of the change of the store-in-store concept, and then chat up the cashiers there. And the takeaway from all that was that it was going great. So take it with a grain of salt.
But in a lot of consumer businesses, I think the best thing you can do is just to walk into the store, right? I mean, if those are relatively, and you have a sense of what, I mean, and what helps me a lot is to take my wife, because a lot of the stuff I'm sort of totally oblivious to. But if you have friends that experience this, and if you get an awesome customer experience, you can sort of see it. And I think in consumer businesses, that's something that you probably can get from. You can talk to people that are there too. Just go into the grocery store, talk to the person checking it out. I think there's a lot of stuff you can do along those lines. And for consumer-facing business, it's more difficult when you're dealing with B2B types of businesses. But consumer businesses, you can do a lot of stuff yourself, I think.
Yeah, there's some businesses we bought where we talk mostly with brokers that sell the product instead of with the company itself. Usually whoever's involved in the sales process is the one who knows the most about what really matters, whether they can raise prices, what the customer really wants. And that's more useful in the ones that aren't consumer-facing because you can't see that negotiation, and it's not always that clear in the 10K and stuff.
Or even here at Berkshire. I mean, I went and talked to a Clayton sales guy, talked with him, someone else that was in the business. There's a lot of different sort of things you can get in terms of, I would say there's somewhat non-standard ways. You're not intending to do it, but you somehow sort of fall into it from a conversation here or there. So,
cool. Thank you.
So this question is aimed predominantly at Shree, but if there's time, it'd be great to hear from everybody. The question is, what have you learned about yourself through the different stages of your career?
Investing is an individual sport. So I've had to evolve over time. As I mentioned, I used to work in a bank. I used to run a small financial services focused fund. And today I run a global long only equity focused fund with no exposure to risk-based, banks or REITs or BDCs or any sort of rate sensitive names. What have I found through that process? Many things. My own capacity to handle, exposure through those types of rate-oriented names, particularly when they go through a fairly gut-wrenching move as they did in 2020, and have had to go through an exercise of self-discovery. What am I trying to accomplish over time? What I'm trying to accomplish is over a 15 to 20 year period, I'm trying to put up at least 10x in my portfolio. What that entails is a type of business that, first of all, doesn't rely on any outside capital, and that meets these criteria that I described. A business that I can understand, that generates high return on incremental capital, and has fantastic reinvestment opportunity. Reinvestment is not something that you can generally pull up in a Yahoo Finance or some sort of a database. So there's a lot of analysis involved, and qualitatively evaluating management teams, sitting across the table, looking at the black of the eye of the CEO or the CFO, trying to understand exactly what he's trying to say, and try and read between the lines. Those are things that I've had to learn over a period of time. And here I am today. 95% of the portfolio doesn't have any debt, very little to no debt. And these are generally fast-growing businesses, trading at valuation that I think is reasonable given the kind of returns that they're generating. It wouldn't meet Geoff's or Keith's valuation criteria. They are pretty strict about what they like and what they don't like. But that's the evolution that I've had to go through. It's a self-discovery process that has taken a number of years to realize what I really want to accomplish.
Yeah, I mean, I think for me, one of the things, my historic business career has been in situations, and a lot of people in finance know this, you put in the effort, you're going to get the result. When you're dealing with asset management, that equation doesn't work. And there's a lot of luck and randomness in it. And if you're not used to that, if you're used to a very steady risk-reward trade-off, transitioning to something where it's not based upon that can be somewhat, it's an adjustment that you have to make over time and think about it. And as an investor, you need to think, okay, is this something you really want to do, and do you have the mental makeup for dealing with that? I think it's a little different than sort of a basically, effort reward type of equation, which is what a lot of the businesses are. And most of people's lives are built around that type of thing, and that's at least one thing that over time I think that I've noticed it's different about. And I didn't expect it in asset management because I wasn't involved in it, but that's just one thing something that's a little bit different than that I wasn't expected. But
thank you for your time. This question is for any one of you. So there's a lot of focus on the attributes and characteristics of a successful investment. I'd like to take a slightly different approach and ask, what would you attribute some of your biggest mistakes or failed investments to, and what could you have done differently in hindsight?
I would say denial. A lot of times, well, I guess Buffett said, like predicting rain doesn't count, building an ark, is what counts. And I would say often at some level what the right thing to do is, and you don't do it. And I think that happens more than people may realize, that you can be slow to take action when decisive action is required. Either way, missing out on things to buy that you understand and you could have big success with, and also selling fast enough on some things too. I think that's underappreciated, people explaining that sometimes it was reasonable for them to know what to do and they didn't do it. We all tend to be a little slow on taking action.
For me, the biggest mistake is mistake of omission as opposed to mistake of commission. The max I can lose in a mistake of commission is 100%. I'm sorry, I keep going back to Copart only because it was a mistake of omission that I now have rectified. I looked at it first back in 2009. My analysis was shoddy, was absolutely wrong. I realized it only a couple of years later, but I did get the opportunity to go back in with a changed attitude towards who I was, what I was trying to do. And then in COVID 2020, the stock went down about 48 or 50%. That was my first, dig into Copart at that time. So it's more a mistake of commission. Most successful investors, Geoff, Keith, Steve, everybody, when we look back at this, that's particularly after you have done a lot of work, for whatever reason, you move on and go after something else. Those types of mistake of omissions is what would be the bigger, quantifiable, bigger amount.
I think for me, it's primarily understanding management and the other incentives of large shareholders. I've had a number of take-unders, and that's really basically misassessing that, okay, and really maybe putting on the wrong incentives. One thing I think you really got to be careful is if you have very large shareholders, especially if they're in private equity, they're coming from a world of, it's me, I don't care about anyone else. And you got to be careful in those situations. And I've learned it the hard way in the fact that these companies have been bought out, but it cuts off your upside on stuff that can look really well. And there's not much you really can do about it, especially in this index world where what happens is as soon as something's announced, all the index funds get it, and the index funds are going to vote for the takeout, even though it's a take under. So, I think that's one thing I've learned as a result in something that's, what it's really done to the performance, I think, of specifically the stocks I've looked at is it cuts off the high end of things. And if you cut off the high end, then that can really affect your overall performance because just from a math perspective. But
thank you.
Yep.
And then we'll take just 3 more of you guys, and then the managers will be here afterwards to chat. So,
hi, I've got one on corporate culture. So to what extent, and certainly for lesser-known companies, is it important, or do you spend some time trying to understand the corporate culture? And could you maybe share some examples, some kind of clues that show you good corporate culture that you like versus maybe, or conversely, clues of bad corporate cultures?
Yeah, we invest in very small companies, so I'd say it's usually not a culture thing. It's really just the people at the top, whether that's a family, an individual. It's very personality driven. We've found usually it's a little bit more complicated than good or bad. They each have their own reasons for running it how they do, and understanding that's really important. Some people never want to fire anyone. Some people want no chance the business will ever go under. Some people want to get really rich really fast and sell to private equity, you know. Some people will even start another company after they do that, you know. So understanding that, yeah.
Yeah, understanding corporate culture involves a lot more diligence. That's part of the reason why I spend more than 80% of my time on my existing portfolio companies. So one example I would throw out here is a company called HEICO, which does aircraft parts manufacturing based in Florida. The founding family, not the founding family, they took control of the company. They own a good chunk of the stock. Father and two sons run the company, and it's an interesting stat. It came up with Keith's comment, and I've heard Geoff mention this, where when you have a CEO who is fine with getting a base salary that is actually lower than many of the other operating managers. That is truly the case in HEICO. And on top of it, of course, they get stock-based compensation and all that, but cash, salary, and incentives, it's actually lower than what many of the other CEOs do. In addition to that, if you go back in time and read the transcripts and talk to the management team, they consistently bring up this idea of secretaries within different divisions who are now millionaires. You know, the company makes it a regular program of providing stock to those, you know, to the employees, not just through their 401k, but also in terms of their regular ongoing compensation. So as a result, you don't see a whole lot of turnover within the organization. So these are sort of you know, cultural issues that are significantly positive. Again, it doesn't translate into a you know, into a significant number either on the balance sheet or the income statement, but it gives you the you know, overall color about how longer term this is sustainable.
Yeah, I mean, one way you can look at it as just an investor, I mean, as Munger talks about incentives drive behavior, if you just take a look at a proxy statement, that'll give you a first start hint, and you can just sort of follow other things going on too, is, okay, if the CEO pays himself 10 times, I mean, think about working for a guy like that, right? I mean, would you want to work for, and what type of ego does a guy have, thinks that he deserves 10 times the next guy down? It's just like, and these guys are all rich to begin with, right? All these guys that are in the corporate sector, they're making millions of dollars, they're in the top 1%. So I think if you look at those, it provides a first thing. But as Shree said, to understand culture, it takes a long time. And it's basically putting together a mosaic of a lot of different sort of pieces of information. But I think a good starting point is just taking a look at the proxy statement and how does the top manager treat his other people that he's working with? And then, because usually, in most companies, culture starts at the top. And you're looking for clues of, okay, how does the top guy treat the people that are working for him? And that, I think, is a good way to, at least to start as a starting point, and then you can get other information around that.
Hi. I have heard Geoff talking about some uncommon moats sometimes, like he has mentioned a local limestone producer, for example, as a moat. So if I try to do like Munger and always invert, what's your opinion about what kind of moats that's most overrated or mostly priced in always? So what kind of moats should I try to avoid because they're always priced in?
Well, sometimes they're not priced in, and so that's why people keep doing it, but network effects, right? So network effects, I don't know how important they are in some cases if you have sufficient liquidity in the local area and stuff. So, you know, there's these cases where they go, oh, it's 10 times bigger than this other one. Well, a lot of times a network that's 10 times bigger than another one isn't worth all that much more as long as they're both big enough. And so write-ups or whatever, that's the one that I see the most. There's some cases where it was huge. And so that's why but still it has a huge payoff if you get it right. And so that's why people put those in, and probably because that makes the people like those write-ups and more likely to buy those stocks and everything.
I mean, another thought on that in terms of like moats, if you think about probably the most destructive force for companies, probably the best for consumers is market fragmentation. So if you notice what Buffett, over time, he's sold all the companies that are fragmenting the businesses, media distribution, media sort of development. And the businesses he has a tendency to buy and his team have a tendency to buy are businesses that are consolidating, businesses where the competition's getting smaller and the pricing is getting better. And so, but I think, I mean, fragmentation is great for consumers, but it's terrible for businesses. I mean, you just, as stark examples of that, you can sort of see what happened when airlines and trucking was deregulated. But that's happening in slow motion in terms of the media businesses, right? I mean, the media business is interesting because you have, like, traditionally you had broadcast TV, cable, and streaming. They're consolidating with each one of them. What's actually happening is the whole thing's fragmented because you have a certain slice advertising pool or whatever that's growing by a certain amount, but it's getting sliced into smaller and smaller pieces. And as more and more stuff comes in, and that just becomes a race to the bottom at the end, right? So it's that I think is probably, at least what I've observed, a really destructive force for businesses. It's great for consumers, but it's destructive for businesses.
Thank you.
Hello, great to see you guys. I've known a lot of you guys for a good long while, and I know you all had great records individually before you started managing money in a fund format. And I'm curious what you found to be the greatest challenge managing within the confines of a fund structure versus what you were doing individually before you became fund managers.
Raising assets.
Yeah, and I think there's distractions involved with that because you're running the business. Whereas before, even if you had a full-time job, but when you sat down to make your investment decisions, do some research, you weren't trying to build out an entire portfolio, so to speak. If you're just doing it for yourself, you'd be more likely to be more concentrated. You're not as worried about the day-to-day or month-to-month or quarter-to-quarter effect of the stock price. But once you do start the business, it's there subconsciously, at least in the back of your mind. So you have to be very, very careful about the investors that you choose to allow in your fund because of that, because you don't want undue pressure from people who have a different time horizon on their investment than you. So it's a lot easier to do as an individual. I think in the fund, it's being very careful and cognizant about the investors and your communication with them and things like that, and making sure that they actually are aligned with what your skill set is.
I mean, I think part of it, too, is the era in which a track record is developed. A lot of it can be, certain stocks can go right, and what happens is inevitably when you've got a great track record over a period of time, everything switches. And then so it's, I think actually running a fund, I've really appreciated sort of the cyclical aspect of this business. I mean, in theory, the best time to raise money is when your style is going to come into favor, has been out of favor for a long time, but you really don't know what that is, and you just sort of started a fund. I mean, I guess from a strategic perspective, you can think about that, but I mean, most of us just sort of started funds when the capital was available from that perspective. But yeah, I mean, for me, I think that's been a big part of it, is just sort of, the styles that you've got may have changed and they create sort of differential. But I think part of that process, though, too, is improving as you're going along, sort of changing your process. You don't want your process to necessarily radically change, but you want an evolutionary sort of development of it and trying to develop into different areas that you can build off of what you've done in the past. I think that's, at least for me, what sort of has happened over time.
Yeah, I mean, I don't have most of those issues because we divide responsibilities, into two separate spheres, and Andrew handles most of the things that they're complaining about. So, but we do manage accounts and the fund, and I'm surprised to the extent that running them is different. That, you know, the way the inflows have come into the fund and stuff is different from how people have funded managed accounts initially and then not really added money to that over time. It's just very different in terms of the flows, which actually has some effects on how that affects your position size moving on its own without me choosing to make it much bigger or smaller. So that was a surprise.
Thank you.
Hello, I'm Melvin, and thank you for the very interesting talk. I just wanted to end off with a kind of a positive and fun question. Buffett mentions about having fun in investing. So I wanted to ask you guys how you guys have fun in investing.
I mean, I think it's all about the relationships. There have been so many, just really, you know, since I started the fund and a couple years before that, when I started kind of networking at events like this, and you know, reaching out to other investors that I respected or answering emails to, you know, from their letters and things like that, and just some true, genuine friendships, you know, came from that I value very highly, and you know, I'm just very thankful for those people being in my life. And so, you know, there's kind of like a joy to that, where there's some like-mindedness, but then even beyond, you know, the day-to-day work-related things, you know, to have these people in your life is very nice. And, you know, Shree's talked about as well, when he started the fund, it can be kind of a lonely process. And so having that and having that community that you're a part of is, you know, I'm just very thankful for that.
Yeah, how many other professions where, you know, the actual work can be fun as well as hopefully, you know, generate revenue for you. So this is a business where, you know, it helps me find who I am, and in that process, I used to run money for a couple of different platforms before I launched SVN Capital, much different, larger organizations, larger dollar amounts, and I couldn't do many of the things that I'm doing today. You know, spirituality is an integral part of who I am. And for me to be able to spend an hour, hour and a half in the morning, that was absolutely not possible, because I was taking the first train out, last train back. And that's one. The amount of general reading, not just the annual reports and the 10Qs and proxies, non-financial related readings. I just didn't have the time to do all those things. So I do read a wide variety of topics, hoping for serendipity to hit me at some unknown time. So those are all the fun aspects of what I'm doing today.
Yeah, I mean, I think my thing again is just each when you're running a small fund, it's all based upon the manager and their personality and approach, and just being able to network, or what it's really provided is the ability to find other people that think like you or similar to you, and you can have intelligent conversations about the various investments and stuff. And for some people, it's really great. I mean, I think we're all sort of like stock market addicts, or whatever you call it, you know, company addicts or whatever. But there's a lot of people that are different out there too, and it's just being able to come up, you know, have a group of people that you can do that with and share a common experience, I think is a very important sort of benefit that I've really sort of benefited from. And part of it, I think, is just, you know, having this group. I couldn't imagine this stuff happening without the internet and all these other sort of communication platforms, in terms of just the acceleration of this process and really making it happen, and the connections happening in a much more, I guess, efficient fashion than they could otherwise.
Yeah, and for me, it's that you'll always find something eventually. You know, it gets very depressing for months at a time, reading everything, finding no ideas, thinking everything's overpriced, and suddenly something will appear. And I've been doing it long enough that I know that there'll be some random thing from someplace that you'll find, because prices keep changing, and knowing that is very, that's the most fun part.
I don't have a question. I just wanted to thank everybody for attending today. Thank you to our panelists, and hope everyone has a great evening.